Okay, welcome everyone to the Global Market Outlook for this 8th of August 2023. The headline I've gone with this quarter is "Too much too soon?" question mark. We're going to try and understand where markets are and I suppose what we can do about it. So looking at the agenda, I've shortened the agenda slightly from my usual event. I'm just going to look at kind of three segments to it. So we're going to look at the economic indicators first. We're going to just get a sense of where the underlying economies are, where the data is, and kind of that's always backward looking. It always you're looking in the rearview mirror when you're looking at economic data. I will discuss our expectations and our forecasts as well, just on the economic data. But the best predictor of economic data is market movements. So second segment, we're going to go through some of the big changes in financial markets. Sorry, can you guys hear me? I've got someone asking if I'm on mute. Please just let me know if you can't hear me. But if you can hear me, just give me a thumbs up in the Q&A box or the question segment. But yeah, like I said, the best predictor of market sentiment and the best predictor, at least, of economic outcomes is market pricing. So we're going to look at some of the major markets. We're going to see where everything is moving and how it's moving, and then I'm going to do a portfolio review. I'm going to have a look at how we're positioning ourselves in the global equity portfolio. Right at the end, I'm going to tell you briefly how things have changed. You'll notice the whole Ransos website is different, and then we're going to discuss some investment ideas. We've got three stock-based stocks we're going to chat about, and then I've got one actual investment idea as well that we'll go through. Okay, so let's get started. Economic indicators. What are we looking at here? So the first thing we're looking at is I've done everything over 3 years for this presentation, just to give you guys a little bit of better sense. So if the chart doesn't have a label, that chart is for 3 years. So the first thing I want to have a look at is what's happened in the last 3 years. Obviously, we've gone through Ukraine wars, we've gone through COVID, we've had the whole global economy shut down and reopen. Crazy things have happened in the underlying markets. So I'm going to start with the US. The US annual inflation rate at the moment, the most recent print was at 3%. That's on the headline figures. We're actually getting the next data point out this Thursday. So the expectation there is for headline inflation, which includes food and energy, to tick up slightly. So we're looking at around 3.3%. That is the expectation on Thursday, up from that 3%. And then we've got the core rate, which obviously strips out the food and energy. That's expected to continue to fall. So that's actually sitting at 4.8 currently. We're expecting that to drop to 4.7 on Thursday. Like I said, that's going to be out soon. But the point of this chart is really to just show you what has happened to the US inflation rate over, let's say over the last year. Now, if we compare, what are the levers that influence inflation? One of those levers is obviously the federal funds rate. So it's interest rates inside the economy. And you can see in the bottom right-hand quadrant what has happened to the federal funds rate, basically over the last year. We've seen 11 hikes from the Federal Reserve, and that's obviously, it's increased the cost of capital, and it should have put a huge amount of pressure on equity valuations. If you just take the time value of money, if you boost up your interest rate assumption, or what the interest rates are, obviously your as an input, your valuation on a stock must decrease. But what has happened over this period, we're going to look at the stock prices. Essentially, from about a year ago, we've seen an enormous rally in underlying equity markets. Now, that to me, to an extent, does make sense if you're not taking any forecasts into account. You're just looking at what was the situation a year ago. So if we look back a year, you can see that the headline inflation rate was 9.1%. So things were inflating. That's actually good for shares. If you own a house and things are inflating, your house is worth more. If you own a pen and suddenly a pen is, it used to be 10 Rand to buy a pen and now it's 12 Rand to buy a pen, or guess what? You're going to get better sales as a business. The problem, of course, is that at the same time, you can't just look at the nominal, if you're looking at that interest rate, at least that inflation rate, what happens when there's high inflation? The Fed gets a little bit concerned, starts hiking interest rate. That suppresses the economy because it increases your cost of capital. Suddenly, when all of the loans that you have in your business become more expensive. Suddenly, basically, if you're looking at a big project, you could just stick your money in the bank. You could get more money on your investment. Now, maybe it's not worth doing these big infrastructure projects. So companies pull back, things get more expensive, consumer spending slows, wages, catch up. I mean, that whole kind of multiplier effect works through the economy. But if you look at, the nominal interest rate a year ago for, let's say interest rates were just getting off that kind of zero bound problem that we had. You've kind of moved up maybe 3 times, maybe 4 times over, if you look back 1 year. We were still, we still had US Fed funds futures rate below 2%, yet we had inflation of around 9%. So your real interest rate was deeply negative at that stage. At the same time, obviously, interest rates continue to hike. Now the situation is very, very different. Now suddenly we have the world inflating at only 3%. But we have interest rates north of 5%. So now you've got a deeply negative real interest rate. That should be very, very negative for equity prices. So I just want you to kind of keep that in the back of your mind. Now, obviously, the Federal Reserve is, if we look at interest rate expectations, the Federal Reserve has its own ideas on where interest rates are going in the future. All market participants have an idea of where interest rates and inflation are going in the future. But the Federal Reserve is kind of pushing a narrative at the moment that they are going to stick the soft landing in the economy, and essentially we're not going to see an impact in the labor market. So we had non-farm payroll numbers out last Friday. The expectation was for about 200,000 new jobs added. The economy added 187,000 jobs, and the unemployment rate actually ticked down to 3.5% in the US. Now, the Fed is saying that they can hike interest rates this aggressively, one of the most aggressive and fastest hiking cycles we've ever seen in history. And they believe, and if you watch the FOMC meetings, I usually watch them. Jerome Powell has said it shouldn't be the base case, and it is against, to use his words, the historical record. But he feels personally that there is a very good chance that they are going to be able to hike interest rates and have this kind of like tighter monetary policy without seeing impact in the labor market and without the US going into a recession. And at the moment, that has been the case. So if you can see, the labor market there's been almost no impact in the US labor market. Unemployment rate is still very, very low. We kind of below what we used to consider a frictional unemployment rate in the US. At the same time, we have much, much higher interest rates. And as you can see from the annualized GDP growth rate, we haven't really seen the impact on US GDP as well. And there's a lot of reasons that this could be the case. It could be technological advances. It could be all sorts. And it could be people in the labor market just too scared that their jobs are going to disappear, that they choose not to go and fight for higher wages, which would make inflation a little bit more sticky. Maybe people, maybe the Fed's credibility is just there, and everyone believes that the Fed will keep doing this until inflation is under control and they achieve their 2% target. There's a lot of reasons why we haven't seen this, but there's a big concern for me. Historically speaking, if we are looking at the historical record, monetary policy tends to have a 12 to 18 month lag historically. And I'm not saying that the transmission mechanism isn't quicker this time. We've seen, market rebounds happen quicker. The whole world seems to be moving quicker with the advent of social media and, the information age that we're living in now. Yes, the transmission mechanism may be a lot faster, but it's not how it used to be. And if you think 12 to 18 months is when the impact of monetary policy is really going to be felt, historically speaking, we started this very, very aggressive rate hiking cycle. When I say we, the world, the Fed, just over a year ago. We're past the 12-month point, but we're not at the 18-month point yet. And there's a lot still to happen that could feed into markets. So the idea that there's been a lot of backpacking by the Federal Reserve, and I've listened to many market commentators saying that the Fed has perfectly threaded the needle and everything is going to be wonderful going forward because they've now got room to cut and inflation is under control, and they haven't impacted the underlying economy too much. that going to happen? I don't know. Maybe that is the outcome, and maybe, inflation stays low. Maybe the labor market ticks up, like the unemployment ticks up slightly in the US. But we see, potentially some rate cuts coming because inflation is just so under control. The Fed always says it's data dependent. But of course, there is the other situation. There is the situation that maybe, just maybe, unemployment, that we've done way too much. And I get the sense that the Fed is starting to see it that way, just from listening to the FOMC meetings, that there's the risk of doing too little and there's the risk of doing too much. And it's very difficult to tell, when you've done too much. And my sense is that it just might be the case that they've done a little bit too much. I don't know. I mean, everyone is looking at this. Everyone has their own expectations. But it is weird for me that we've hiked interest rates as most aggressive interest rate hiking cycle, in terms of speed ever, and no impact on the labor market, no impact on growth. Weird, very weird. It's going to be a very interesting, I'd say 12 to 18 months for underlying economic data. But again, remember, economic data is backward looking. So if we just look at it, and this is specifically for interest rate expectations, the bottom right-hand quadrant, these are the probabilities of what the Fed will do on underlying interest rates. And I'll talk a little bit about the spike in bond yields that we've seen recently as well. But if you look at this is the next 4 Fed meetings. So the next one is on the 20th of September. The overwhelming probability is that there's going to be no move in the US interest rates. There's the sense that the Fed is staying pat, 84% chance that we stay at the current federal funds rate. The next meeting will be in November, so 1st of November. You can see there is still, market is pricing no chance of a cut by that stage, but there is, more than a quarter, call it around a 30% chance that we will see a hike by then, or very slim chance we'll have seen 2 hikes. But probably if I had to bet on this, I would say that we're going to see no hike in the next meeting, and then we could see a hike in the next meeting, but I think flat. I think the risk at the moment, and it's all going to be data dependent, it's going to depend on what happens to the inflation data on Thursday. It's going to depend on what happens in the next non-farm payrolls prints. It's going to depend on all that economic data that the Fed is sucking in. But as it stands currently in the market, and I pulled these yesterday, I think that if you had to bet, I would say no change now and no change in November either. I think we're pretty much at the top of the interest rate cycle from the Fed's point of view. And then you look out to the December meeting. At the beginning of the year, me and Viv made some bold calls on when the first interest rate cuts would come. I think Viv was very convinced that we were going to get, well, not convinced. He said it was a borderline decision, and he wanted to kind of do it on the edge. But our official prediction was that we would get 1 rate cut this year. I was a little bit more skeptical. I thought maybe the first quarter would be the first rate cut, but looking at it now, the idea is about a 5% chance that we will be 25 basis points lower than when we are now in December. And obviously, this is all going to change. We've still got a lot of months worth of data to come through. And these are just the best predictions based on the federal funds futures pricing. And then in the January meeting, there is about a 52% chance that we're at the exact same rate. Now, that doesn't mean that we couldn't have raised once and then cut. But then there's, call it like just over, so call it a 27% chance that we're lower in the interest rate cycle than we are now. So that's kind of where the expectations are. That I do get the sense that we're getting to the top of the cycle, and that interest rates, I don't think, are going to move up too much more. If we look at what's happening now, the market does seem to be pricing a longer period of higher interest rates, We're seeing that in the bond market a little bit. So we're seeing, we had obviously Fitch downgrade the US credit rating. That was, most of the commentary around that has been that was largely expected from the market. There shouldn't have been too much underlying impact because Fitch was essentially reacting to things that were already in the market. And, the US is, the US dollar is still the global reserve currency. So even when they get downgraded, the dollar is actually strengthened. We'll look at the currency in a bit too. But there is just a sense that I mean, US bond yields have been spiking slightly. And I don't know if it's got to do with the risk premium, but I think it's more likely to do with the fact that the market is seeing that we will be moving into a higher interest rate environment almost not permanently, but maybe not at the levels we are now, but that we aren't going to go back to that kind of zero bound problem, that maybe we're going to be over the next 10, 15, 20 years, we're going to actually have interest rates at reasonable levels. We're not going to have this kind of very odd situation that we've had over the last 10 to 15 years. So we are seeing that kind of starting to price in the underlying bond market. But I think a little bit nervous. I think there's a lot of uncertainty out there at the moment. I think very good news that in my opinion, that we're getting to the top of the interest rate cycle. But why do you need to aggressively cut rates? Because things start to go wrong. I think you're going to see economic pain coming through. I'm more skeptical of this idea that we're going to stick a soft landing and we're going to get inflation under control and everything is going to be hunky-dory in the underlying economy. I think we could see some contraction in the US specifically. I think times are going to be a little bit tough. It's not what the markets are telling us, though. But looking at the last 3 years, this is the SA economy. So a similar picture, but also a different picture. So you can see, South African growth rate, under a huge amount of pressure. We just can't seem to grow in South Africa. That is the obviously structural issues that we face. When you don't have power and you've got kind of insane government policies, it's tough to get an economy to grow. Our unemployment rate has actually benefited over the last, remember, all of these are 3-year charts. So unemployment rate has fallen. There's lots of reasons for that, and I'm not going to get into the technicalities. Part of it is also just the big uptick we saw in commodity prices, which it benefited our local currency. It also, it improved the South African fiscus as well. Obviously, there was better tax collection. Commodity prices have fallen. We're going to look at commodity prices in a while. I don't know if we did enough as a country when things went up. You guys obviously watch the news. You can see kind of the unrest that we're seeing now in Cape Town. It's a difficult place to operate. It's why kind of we look at it. Yes, there are massive opportunities in South Africa when an economy is not functioning correctly. That's where business really can make a big difference. But at the same time, it depends on who you are as an investor. If you have discretionary money that is sitting outside of, let's say, the Reg 28 framework, and you can internationalize it, and you live in South Africa and you work in South Africa, you have a lot of risk in South Africa already. Your discretionary investments, in our opinion, should largely be overseas. One of the reasons that we run the global equity portfolio, but this is an economy that is feeling a lot of pain. You can see we've kind of matched the US in terms of our interest rates. That's putting huge pressure on local businesses, huge pressure on South African consumers, of course. And you can see our inflation rate, while not kind of spiking out as much as the US did, it hasn't moderated quite as much either, but our interest rates are obviously heading back in the right direction. We're back within the 3 to 6% target band. The SARB governor has come out and said that they want to anchor expectations around the midpoint of the 3 to 6% band. So they're looking at 4.5%. 5.4 is still above the midpoint of the band. So don't expect too much relief too quickly. And of course, we're going to be very linked to international markets as well. So that's the rear view look. That's what's happening in the economic data. That's where we are at the moment, with a little bit of economic forecast, if you want to put it that way. But let's look at some of the market movements and what's happening in underlying pricing across the equity, commodity, and currency markets. So the first thing I just want to look at is market sentiment. So I always love this sentiment indicator. It's actually, you can get it off CNN, the Fear and Greed Index. Now, it's actually a composite of a whole lot of different fear and greed gauges, if you want to put it that way. One of the inputs is the volatility index. I put the volatility index down on the left-hand side, so that's the VIX. And you can see what's happened recently. Bottom left-hand side is the VIX, bottom right-hand side is the S&P 500. And you can see what has happened over the last year. If we go back to kind of July 2020, if you go back to around here, you can see we were just about at all-time, that was kind of the low of the movement. We did get slightly lower lows, but that was when inflation was at 9% and interest rates were nowhere. From there, that was really your buying opportunity, I suppose. And at that stage, it was extreme fear. Anyone that went through that will remember the panic. But since then, we've had an incredible recovery this year. Now, this is just basic technicals. You can see there was kind of that break, a retest, a break, and then a retest at that for me, you should have been kind of sitting a little bit on your hands over the last year, but that sorry, when I said test and retest, those are all the tests. The break, the retest over there on the orange circle. The orange circle was the best time to buy into the market. I mean, that was like the clearest technical break and change of channel ever. Where are we now? We're still within that channel, but I do just feel like in the short term, we are a little bit pricey. You can kind of see we're pinging that top of that trend line. I think it can be quite easy, maybe not to the bottom of the trend line, but definitely a little bit of a pullback it might be on the cards. We're starting to see that spike in the VIX here. So the volatility is moving up slightly. We're up to about 17 from about 13.5. But overall, the market's still in greed territory. So what are the other inputs into this? Volatility at 17 is still quite greedy, if you want to put it that way. The spike was kind of the pandemic spike in 2020. You can see the volatility got all the way, above kind of 60. That kind of matches the global financial crisis impact on the VIX. And just remember the VIX. I'm going to talk about options a little bit later as well. So remember that the VIX is very, very low. So that's actually saying that things are a little bit greedy. But then there's other things within this index. Things like the put-call ratio is still below 1. So that's puts essentially buying insurance. If the market's going to fall, calls, you're buying options to see if the market's going to go up. If there are more calls than puts, then you basically work out the put-call ratio. And if it's below 1, it kind of indicates a little bit of greed. There's other things like it also measures market breadth. There's a couple of other measures under there. But basically, people are feeling optimistic, and you can understand why. Markets have run hard. Where we hit the peak a couple of weeks ago, I mean, we're only 4.3% in dollars off all-time highs on the market. That's an aggressive recovery. At the lows, we were down about 27.5% in dollar terms. That was the dip. Okay, so that's kind of where we are at the moment. If we just drill into the equity market a little bit deeper, you can see this is actually over 3 months. So these are the moves that we've seen over the last 3 months, and you can see where it's come from. It really has been dominated by technology. NVIDIA up 62%. We're going to talk about NVIDIA in a little bit more detail later. Meta 33%, Google 22%, Amazon 34%, Tesla up almost 60%. So it has been quite broad-based. I mean, when we spoke 3 months ago, I said there was a big concern that it was just the magnificent seven in the market. It was essentially these 7 stocks were accounting for just about all of the performance. We've seen more stocks kind of moving into the bull run, which is a good thing. You can see kind of the traditional defensives over here. So like the likes of the healthcare, spots of red, consumer defensive as well. Also spots of red, utilities, another sector that's been hit. So it's kind of those traditional value sectors that have been hurt. And I don't know if that's people looking forward and saying, hey, wait, interest rates are going to come down. We're going to shift back into technology. We're going to shift back into growth stocks. And the very brief patch of sun that shone on value managers is now covered by clouds once again. I don't know if that's the case. Like I said, I mean, value managers might shine once again. If we do see proper economic pain coming through and people starting to worry about this largely AI-driven rally. I mean, everyone's been very excited about AI. And there's some risks to this rally, I think, as well. One is that the interest rates will stay higher a lot longer than everyone expected. They've got their pricing wrong. Suddenly, you might see a moderation in some of these tech stocks. But that's essentially what has happened. Remember, the market is a wonderful predictor of economic data. So if the market is saying that everything is going up and it's wonderful, maybe the Fed is right. Maybe I'm going to be proven wrong here. And literally, markets are a great forward-looking device. So markets are saying that things are going to be great, and the Fed is right, and that they're going to stick the soft landing, no problem. And the U.S. economy is not going to falter, and the U.S. labor market's not going to get very bad, and things are going to recover nicely. So that's the U.S. markets. And then this is just looking internationally as well. And you can see there's been a nice resurgence in China. I've got a Chinese stock we're going to look at today. Alibaba up 17%, Baidu 22%. Look, China looking a little bit better. This is one that they've ended their zero COVID policy and the lockdowns have ended, but also that we're getting some I suppose positive regulatory rumblings out of China as well. So I mean, I don't know if you guys remember a couple of years ago, stroke of the pen and you can wipe out the education sector in China. So it's the environment they operate in, but at the moment it seems more conducive to business in China, and we're seeing a little bit of an uplift in Chinese securities. Europe still strongly. I mean, there's been spots of excitement in Europe. The automakers, likes of BMW, etc., have done very well, but not as robust as let's say the US. Okay, if we just move to commodity markets, I've just lumped these all into 2 slides. I normally do like 6 or 7 slides. I'm trying to do a different type of presentation. So I've just added, so we've got the Refinitiv Commodity Index and the Bloomberg Commodity Index. So you can see over the last couple of months, we've actually seen an uptick in the general commodity prices, but nowhere near what we saw, over the disruptions following the Ukraine war. The net beneficiary, that South Africa was for higher metals prices, and remember when PGM prices were going berserk, and PGMs have come down significantly. But these are just 2 aggregate indices to show that it's moving up. I've also put on Brent crude oil, so that's in green. So you can see Brent crude oil's also moving up quite aggressively. Remember, this is going to be an input into inflation as well. So if we're hoping that inflation is going to stay low, and the Fed is going to cut interest rates, if oil prices are moving up, that's a huge input into inflation as well. So just be careful around that. We've obviously had all the ructions around, escalations in the Ukraine-Russian conflict, and the idea that, potentially we're not going to see wheat moving through the Black Sea channels. And we've seen a lot of volatility in wheat over the last couple of months around that news as well. So huge spikes in the wheat price, which is the red graph. And then I've just stuck gold on there in blue as well. So you can see gold prices have done almost nothing over this period. So for the gold bulls, sorry, this has not been. I kind of see gold more as a currency anyway, and it's kind of it's a diversifier. I think you should stick gold in a safe, not in a portfolio. But some of the gold miners in the local on the local exchange have done very well. But gold largely over the last 3 years has done very, very little. So you've actually got gold price in dollar terms down around 4%. Much better to buy things that compound and give you a return and have humans working out what to do if you actually want to make money. It's a hedge, it's a diversifying thing, and it hasn't done too badly from kind of the lows, but overall compared to other commodity prices, it's actually performed pretty poorly. Then if we just look at the soft commodity market, I like to put this chart on. It's all sorts of different softs. You can see that softs over the last 3 years do remain very elevated. And I mean, if you think of soft commodities on input price, yes, it's an input into food prices. They haven't come back, particularly strongly. I mean, these prices are elevated, they're inputs. They're also, you need to feed into your idea of where inflation is going and inflation expectations. And you can see something like the blue one up 166%, that will be orange juice. So that is, what is orange juice? Frozen concentrated orange juice. That's up 166%. But even okay, rubber is the one up 10%. But over 3 years, I mean, you're still talking about well over a 10% per year increase in most of these underlying soft commodities. So the idea that you're going to get a big drop off in inflation because soft commodity prices have fallen and food prices are going to go down, it's not really the case. The data doesn't support that argument. So why is inflation going to keep falling? I don't know. Without some impact in the underlying economy from the Fed's moves, I don't know. It's not going to be commodity prices coming down, well, soft commodity prices coming down, because they just haven't. Okay, if we go to the currency markets, obviously South Africa, they say that trying to time the rand dollar exchange rate is a South African national pastime. It's one of our greatest sports. So I'll add my 2 cents to the debate. So if you look at it, this is just some technicals on the US dollar rate. If you are looking, like I said, we work a lot with international markets and international investors. So we've got guys who bring currency back. We've got guys that take currency out. We're launching a structure at the moment. So a lot of people are looking at it going, oh, but where do we take money? Our currency desk, after going through a couple of very dead months, I think the biggest month it's had in a long time when the currency moved below 18. A lot of clients were getting involved and obviously using the weakness to use their offshore allowances, that 1 million allowance specifically. We've seen huge challenges. I mean, if you guys are thinking of applying for the new AIT pins, it is tough. It is really tough. We've got a couple of applications in at the moment, and I can tell you, when we do the paperwork, it's perfect, and we just can't get a turnaround at SARS. I don't know if it's because tax season opened, but the traditional, we used to be able to get them through in about 5 days. Now 21-day turnaround, and you just can't get answers out of SARS. So if you are thinking of doing more than $1 million using your 10 million rand allowance, got a tax practitioner that does it for you guys, but just bear in mind that the process is starting to drag at the receiver to get that foreign tax clearance certificate. It's tough. So if you're thinking of using it, rather apply earlier. If you do it through us, obviously we do it for you free of charge, as long as you do your transaction through us, wherever you're sending the money. But that's why I always look at this currency, because we do a lot of trades in it. So these are the big bank and broker polls from the 2nd of August. So it's about 6 days old at the moment. You can see that the banks are actually fairly optimistic on where the USD ZAR rate is going to go. We've had obviously that blowout to almost 20. We've seen a big aggressive recovery. I think everyone that looked at that blowing out went, wait a minute, this is almost back at 1750. We need to get out. And now we've seen obviously the blowout. We've seen commodity prices coming down. We haven't seen Chinese stimulus, which is obviously a concern. We've seen the US dollar getting a little bit stronger. And of course, we've had our own kind of domestic challenges. We haven't been making the best headlines, but we almost never make the best headlines. And of course, we've got persistent load shedding, etc., which always impacts the currency. But we have seen a move from that 1750 level all the way back to about 1870 when I pulled this chart yesterday. But the big banks and brokers are more optimistic than they've been. Most of these are improvements on previous forecasts from a couple of months ago. The most bearish bank is still SocGen. They believe this is a 12-month forecast, so they think that the rand dollar will be at 21 in 12 months' time. Then you've got Julius Baer, 1850, Standard Chartered sitting at around 1807, and 1807 is stronger than where we are now, significantly stronger. Investec at 1750, ABS at 1730, Goldman Sachs at 1640, 1675. Goldman Sachs is always fairly bullish on the South African rand versus the dollar. And then obviously the most optimistic is Swedbank. The median forecast is sitting at, I haven't put up every bank and broker forecast here, but the median is sitting at about 1758. If you look at we had the Big Mac index come out a couple of days ago. So if you look at Bergonomics and you look purely at PPP, now they're saying we're 50% overvalued, and that potentially if you were to buy a Big Mac in New York versus buying a Big Mac in South Africa, our currency actually should be around 9 rand to the dollar. That is just, that's what PPP says, but unfortunately that doesn't take into account the risk premium. It doesn't take into account future expectations, and it doesn't give you it's not a great valuation tool, let's be honest, because we're perpetually undervalued when looking at PPP and when using the tongue-in-cheek economist model on the Big Mac. But yeah, where is the currency going from here? If I had to put my finger on it, I think we're middle of the range at the moment. It depends what you're doing. It depends what you're buying. I think markets are a little bit high. If I was looking to deploy new funds for clients at the moment, internationally into one of our equity portfolios or offshore investment, I would get the paperwork done now. If we build it, if we're opening a Swiss bank account for you guys and doing it with our Swiss partners, it takes a couple of weeks. The rand is super volatile. In the last 2 weeks, we lost almost 10% against the dollar. We could reverse that momentarily and then reverse it again 2 weeks later. And I think the important thing for me right now is we're middle of the range. I wouldn't be bringing back dollars. I wouldn't be probably taking out dollars unless you have an underlying investment that you're going into. It's not the perfect time. Not that there ever is a perfect time. I'd rather probably be invested than sitting on the sideline waiting. But I would say between 17.50 and 18, you should be pushing the button and getting and buying your dollars, getting ready for deployment overseas. If we do move up to kind of, I'd say 1980 to kind of like 2020, bring it back. Then I think the opportunity is to bring it back. We've got that wide channel that I've got up here. We could easily go and test the top of that, but we could easily test the bottom of that as well. Very wide channel, and I'll try and buy in that channel until the channel changes. But again, just remember, it's far more important to be invested in the right things. Sitting on cash, and I didn't put the cash charts up here, but sitting in cash long term in a high inflation environment is just suicide. It's absolutely suicidal and not what you should be doing long term. I say with a big cash weighting in my portfolio, not a big one, but a little one. Okay, if we just look at the US dollar, you can see I do think that the US dollar is maybe a little bit overdone at the moment. So you can see, okay, so I've just put up cable, euro, and the dollar index. You can see the dollar index has strengthened. Recently, we've had a little bit of risk off trade. So the dollar has just poked its head up to the top of that kind of down channel. I think it's quite easy that the dollar could reverse here. The dollar reverses, obviously, from a rand dollar point of view, rand is going to appreciate. You might get another bite down in that 17.50 to 18 channel. You know, same picture on cable. You know, dollars appreciating against pounds. Same picture. Not quite as aggressive in euros, but this is short-term dollar strength, and I would probably be using this to use your stronger dollars to deploy into underlying markets. If you've already bought your dollars, this is the time, I think, to start looking at how you're going to deploy them, because I don't think you're going to get any major movement just off the currency necessarily. It's not like the dollar is super undervalued or super overvalued, in my opinion. Obviously, if you're just going to go buy an S&P 500 ETF, I can go back to that slide. I think S&P 500 ETFs, if you're just going to go and buy the headline index, I think that's a little bit pricey. If you're a savvy stock picker, I think there's a lot of bargains out there at the moment. I think that Magnificent Seven has dragged up the index, and I think you might get a little bit of rotation out into the rest of the 490 stocks, and we're already starting to see that. And I think there's some really nice things that you can go and buy. But yeah, I think buying an index at the moment may be a little bit dangerous, but maybe deploying dollars into some undervalued stuff. That's kind of the action that we're taking and the action that I would suggest. So let's have a look at our portfolio. So our portfolio, this is where we're at the moment. So you can see, I'll just start at the top left-hand side, there's been a little uptick in our cash weighting. And that's because we trimmed half of our NVIDIA position. I'll take you through that decision shortly. You can see since inception, we're up about 105, just over 105%. This is as of today's figures. The rest of the figures are at month end on the fact sheet. You can pull the fact sheet off the website these days. I've just done top gainers and losers year to date. Obviously, we've had like a big position in NVIDIA, which has been great for us. So we've had a huge gain on NVIDIA. This is based on a $100,000 portfolio. So $12,000 is about a 12.6% contribution to performance from NVIDIA. Alphabet, obviously AI, Amazon, AI, everything is AI. That's what's worked. And the kind of big winners of the past, or of the past, say 2 or 3 years, the more defensive value-based stocks, those have been the losers. So the likes of, okay, not Nike, that's more consumer discretionary. I still like Nike. We've been putting it out as a pick because I think it's starting to show value. I'm not talking about it today though. But Pfizer, of course, Pfizer has been under pressure. So is Lockheed Martin. It's kind of those traditional value stocks, moving down after the spectacular runs and the defensive quality that they provided us in the difficult year that was 2022. Why we kind of tracked markets lower instead of, we have a tech bias in this fund. I mean, I like technology companies, I like growth companies. And yet, in a downturn where the NASDAQ was the most punished index, we fell in line with the S&P 500, not in line with the NASDAQ. And it's really because of positions like this that just anchored our portfolio and helped us to survive a downturn far better than if we were just exclusively focused on tech. But then 3 years, and I'm going to show you why we're looking at 3 years as well, because 3 years is the one segment I'm underperforming in. So I just wanted to kind of do an autopsy and have a look at it for this as well. But obviously, NVIDIA has been our big winner, but that's largely because we've taken a big run up in NVIDIA this year, Alphabet as well. And then JP Morgan Chase over 3 years has been another one of our big performers. Alibaba, we're going to talk about today. So that's one of our big losers over 3 years when I'm doing the autopsy. Walt Disney and General Motors also kind of more of our kind of value plays. Still like Walt Disney, still like General Motors. We're not going to talk about them today. I'm going to kind of focus on Alibaba. As of today, we're up 16.6% in dollar terms for the year after costs. And you can see our performance going all the way back. This is just system generated. So you can see it going all the way back when we started in June 2016. So we have like almost over a 7-year track record now, which is pretty good because I was doing some fund comparisons. And it's actually difficult to find funds that have a track record as long as us. So it's obviously I'm just getting old. But that's not a bad thing in financial markets. Like, it's time in the market, I guess. So this is just like a view of what's inside our portfolio at the moment. So as I said, NVIDIA has actually been trimmed. So we're almost at 10%. So I've trimmed it back to a 4.5% weighting in the portfolio. It's still a large holding in our portfolio. And we might be trimming it further. Just, it was getting to just such a silly level that we had to cut it. But Alphabet's still kind of very prevalent. We run this whole portfolio is built on kind of quantitative stock selection methodology. Alphabet's still ranking right up there with the top stocks. So we're kind of comfortable to hold a heavier position in Alphabet. Visa also a large weighting. And then JP Morgan Chase and BlackRock. BlackRock, it hasn't been a great performer. I do like BlackRock at this stage, but again, I'll talk about my 3 stocks. Since inception, our portfolio up 105%, as you can see roughly. Over 5 years, we've done 53%. And I looked at that and I was like, 5 years, only 53%. We're ahead of our benchmark. But I don't often compare to other funds because I'm a stockbroker. Well, I'm going to say stockbroker. I'm a securities broker. So my background has always been in selecting underlying companies and chatting to guys directly about underlying positions, chatting to fund managers. It's not the traditional wealth planning role where this is this balanced fund and this. I don't look at CIS as much as I look at the underlying drivers of value. It's one of the big USPs of transfers. Is one of the things that we do for our clients is we try and find a way to get you as close to the underlying asset as possible by stripping off all the layers of fees. I mean, why do you need like a fund manager and a broker and a fund of fund managers helping you to select the fund managers when the underlying companies have management teams that are already trying to make you money? So, we kind of try and strip off that and get you quite close to the underlying assets. It's always been my kind of underlying philosophy. But we've seen the benefit of having financial planners as well. We've just hired another certified financial planner for our clients because a lot of guys working with us, and they want that kind of personal touch. They want us to put our portfolios in the context of their overall portfolio. They want an advisor essentially. So we, if you want it, we supply it. And I mean, I was just taking the new guy, Kyle, through our performance, and he was blown away. He was saying, but this is better than like some of the top performing funds in the country. I was like, I don't know that. I just look at the MSCI World Price Index. That's my benchmark. And I try and pick you guys the best companies. So I thought, actually, I don't really do this analysis because I don't compete against other fund managers. I mean, we build TSPs, direct stock portfolios, a different product. But let's go and compare it to some of the big and very popular, very high AUM fund managers, which I've called Big Green, Big Gray, and Big Gold. So if you have a look at it, and I've just done a 5-year performance chart on this one, just to kind of get a sense. Sorry, like it just happened to. I should have done a 3-year, and then we could have checked the underperforming. I did a 3-year on the next page, but we did 53.53% in US dollars over the period, and these are the equivalent of global equity portfolios. Big Green did 43%, Big Gray did 27%, Big Gold did 27%. I mean, we've beaten the best fund managers in the market. And, I don't know. So I thought I'd put that chart up for you over 5 years. We've done really well. And like I said, it's actually quite difficult to find funds that have been around for 5 years. There's a lot that have been around for 3 years. And then you're kind of like, oh, we can't use that one because it's got no track record. So looking good. Yeah, we saw nicely ahead of the MSCI World Price Index, which is what our benchmark against. Some guys are, well, why do you have this benchmark or that benchmark? It's just for us, it is quite arbitrary because remember, we don't charge performance fees to our clients. There's kind of like the different fees that people can charge. We try and cut your underlying costs down to a frictional rate. We don't charge like an initiation fee to take you on as a client. We don't charge a performance fee because I believe performance fees incentivize taking too much risk. If you pay me if you pay me for performance without me taking into account risk, obviously I'm going to swing for the fences, because if I lose, you lose money, I don't. But if I win more money. So, obviously I would try not to do that, but I mean, you get what you pay for as well. So we choose not to incentivize our portfolio managers based on performance. We just incentivize them on a flat management fee, because what does that do? Flat management fee actually creates a situation in which they need to keep their clients in the portfolio. We only break even on the average client around year 3. Anyway, so we need you in the portfolio for at least 3 years before we start making money. And if you're not happy with our performance, or things are not going well, or you're not being serviced, or you can't get your statements, whatever reason that you get unhappy with us, and you leave before 3 years, we've lost money. So we always like the management fee as a better model. So the benchmark here is largely academic. I beat the benchmark, but who cares? Because I'm not taking any performance fees anyway. We could benchmark against anything. But I like the benchmark just because it gives you a sense of what, just a sense of a comparison to what you're getting when you buy the fund. And what are you getting when you buy this fund? You're getting a multinational blue chip strategy of some of the biggest, most exciting companies in the world that have operations across the globe. And it's kind of designed to create equity exposure in the offshore environment, the kind of stuff that you can just buy and forget about, and let the market do its work. And obviously when things like NVIDIA get too expensive, we'll trim them for you. And when there's an opportunity and we like something, and our quantitative model says, hey, that's a good one, we pick it up and we try and generate you the best performance. My own money is in the fund as well. So I'm basically just trading my own money, and you guys can tag along if you want, tag along. So now, like the key component here, that was the performance. Now let's go and look at what is the risk. So risk is always more difficult to explain to clients. I mean, I can take you through the volatility scores. I can take you through different risk metrics, but the easiest way to picture risk in terms of volatility, and I mean, risk, we can get into a big discussion when I talk about the structured product later, but it's just how much movement is there in the portfolio when things go right and wrong. So I've got this bottom chart for you. It just shows you kind of what you can expect. You can see sometimes markets get rough and we get these big spikes. So it gets good and we get these big spike months, but then other months, you get these big drawdowns. And, you can see the chart there. I mean, a single month, we could potentially have a 10% drawdown, even more than a 10% drawdown. And that's in a COVID and all of that. But inevitably, when you have those big drawdowns, that's the opportunity to buy into our portfolio. That's the opportunity to buy into stock markets, because you inevitably get the big recovery afterwards. So this was COVID, and you can see we kind of called COVID a little bit, which helped. But you can see in the sell-off, the market, which is the gray bars, went down a lot more than we went down. And then obviously the red bars are us. So we didn't fall as much as the market. And then in the recovery, because we were buying low down, we actually grew more than it. A little bit more difficult with the Ukraine-Russia war. I was kind of not as certain about this, and we were moving. There was this big skew into value, and I didn't think that I didn't think it was the right time to start trimming our big stuff. Also, we've got a lot of private clients in this, so we're trying also not to, we kind of try to mitigate your tax impact as well. So just pushing the button and exiting everything because we think the markets are going to get shaky is not a very clever thing to do, because you're going to have a massive capital gain that you're going to deal with. So we kind of are quite cognizant of that. We're not trying to do that for clients. But yeah, you can see we've gone through a very volatile period in 2022. It's up and down and up and down. So that's kind of the volatility has increased a little bit. But how does that volatility compare to the big guys? How does it compare to the big guys? So F1 is the Rand Swiss portfolio. So our volatility is kind of in line. We're actually lower. Volatility is on the x-axis. You can see out of the three, the big golds, the big greens, and the big grays, this is over a 3 year. I can only pull a 3 year scatter on this tool. We actually, I was going to do it on another tool, and I ran out of time. But you can see we are actually, out of those, the big portfolios, the big equity portfolios that we've outperformed in terms of performance. On a 3 year view, we've also outperformed them in terms of volatility as well. So, like volatility, obviously lower. You can see F also, this is over 3. So Big Gray actually had a really good performance here, a little bit more, a couple more units of volatility than we had, but a great performance here over 3 years. But remember, over 5 years, we still beat them. And remember, if you go back here, I've had the roughest 3 years. 3 years has been very tough for us. We've been running this for 7 years. We generally outperform over just about every period, not by huge amounts, but we have outperformed. But the 3-year period is where I've really struggled, and it's been a hard couple of years. I mean, I'm not going to lie, it's been difficult. So that's where we've struggled compared to our benchmark. But yeah, I think I'm optimistic about the future. So that's the volatility. And you can kind of see that like per unit of risk you're taking, our risk is actually down as well, which is so nice to compare to the big funds. Okay, so now I'm going to get into the 3 stocks that I just wanted to chat about, give you guys a little bit of useful info. So as I said, on the 14th of April, I did talk about this one last time around. We have added Citigroup to the portfolio. I thought I'd just include it again because you can still get into it. It's actually dropped another $4 since we initially entered. Not worried about it at all. Remember that we bought this in May 2020. We got the big run up. We exited at 68.71 where the red line is. And now it kind of, when we exited, it's fallen all the way back down to our old entry level. We still like the bank. It's by far the cheapest of the big US banks. This is a big multinational bank. This is not speculative. Oh, we think Citibank is going to go bankrupt. It's kind of still too big to fail, even though it's not, I think it's the 3rd largest by assets in the US. But you can see I've just done like some PE ratios for you on trailing 12-month. Citigroup is trading at a 7.3 compared to JP Morgan, which we also hold, is trading at a 10.1. Wells Fargo at 11.2, Bank of America at 9.2. So you can see it's significantly cheaper in earnings terms than the other banks. That does add a margin of safety. I've included the investment banks as well. So Morgan Stanley at 15.7 times, Goldman Sachs at 15.2 times. So in earnings terms, it is the cheapest. Objectively, it is the cheapest. Why do I want it? Again, I don't know what's going to happen in the US economy. And as much as I look at it and I go, ooh, maybe we've hiked interest rates too aggressively, and maybe this economy is going to fall apart, and the US is going to go into a deep recession, the labor market's all going to fall apart, and it's going to be a doomsday scenario. I don't know that. I really don't know that. But that does seem what Citigroup is priced for. So what happens if I'm wrong? And what happens if instead you get a wide, like unemployment does stay low and we get solid GDP growth out of the US? And these banks have high interest rates where they are earning a fortune, and their credit books don't weaken because people still have jobs and people are still working. And suddenly this looks like a steal at 7 times earnings, or as a value, kind of a more traditional value play. Maybe people get a little bit concerned that interest rates are going to stay higher for longer, and we see a rotation out of the growth stocks. This will be a pure beneficiary of that, and suddenly you'll see a lift again, maybe a lift back up to 68.71, in which case we'll sell the share. But yeah, I do think the other thing is, I mean, we've obviously got a big AI flavor to the business at the moment. And remember, all the portfolios that we create, so we've got a local portfolio, global equity portfolio, now we have the AI portfolio run by Viv. They all are to an extent complementary, and it's really because I invest in it, the business invests in these, and it's where we believe the best money is going to be made. And I mean, we obviously like AI, and we don't hold this within the AI portfolio, but the idea that like what banks can do with large language models, I think is incredibly exciting. I think it could change banking in a significant way. So longer term, I do like this even from a technological implementation point of view. And then, of course, just looking at the underlying operations of the company, it is a huge focus. There's a reason that Citigroup is a little bit cheaper than the rest. They have had some issues operationally, but it is a huge focus for the bank to get these right. So you've also got if they do manage to operate a little bit more efficiency, you could easily see a P lift. Even if you don't see an earnings lift, you could literally just see the price improvement and commanding a slightly higher multiple from investors if the story gets a little bit better at Citibank as well. So at Citigroup at least. So I like it. I think it's worth buying. It's still below our target range, so I thought I'd share it with you guys just to show you what we did last time. Like I said, 45.50 was our previous entry on the 20th of May. We sold about a year later, made a 51% point-to-point return on that. and now we've re-entered at 49.20. What are the risks to this? Well, the risks are what I discussed earlier. What happens if interest rates come screaming down because the world is falling apart and our economy is broken? This is not going to be the place for you to invest in. It might still be, because banks are traditionally far more defensive. But yeah, obviously it's a beneficiary of higher interest rates. You don't want them to have everyone defaulting on their loans. It will be a more difficult environment for Citigroup, but like I said, I kind of feel it's priced that way already. NVIDIA, which we've talked a little bit about as well, but I thought I'd just have a look at it in terms of where we are currently. I need to update that chart still, but NVIDIA, there's a video, I didn't update that chart. So investment case, okay, so it's obviously a market leader in AI. Now, remember, we first picked up NVIDIA, I think it was in 2017. I can't remember the exact date, but it was actually when I was covering Mobileye, and we started getting excited about NVIDIA because of the artificial intelligence application at that stage, 5 years ago, long before artificial intelligence was really the buzzword that it is today. We bought into it there based on the thinking that this was a great AI architecture. And their technology is going to have wide appeal. It's not just, Mobileye is essentially, they basically create the maps, and it was a supplier to Tesla at the time on how to recognize roads for self-driving cars, and they were using all these NVIDIA chips. But the application is an FSD, so full self-driving. It's like augmented reality and metaverse. We've seen the new Apple Vision Pro coming out. That really is just the start, I think, of augmented reality, and that huge processing power required. And then, of course, artificial intelligence and AI training and all of that it's going to be a beneficiary of this. So yes, it's a very, very exciting company. It's had a fantastic run up, and it's currently still 4.5% weighting in this. The addressable market for NVIDIA. Guys, can you hear me now? Can you hear me now? Is the sound back? Yep. Sound's back. Okay, perfect. So sorry about that, guys. Like that's battery technology that we need to improve. Sorry, it's probably not going to be as clear as it was, but hopefully you guys can hear me. I'll speak a bit louder, but yeah, like I said, like the key risks to NVIDIA at the moment, the reason that we trimmed it on the 14th of July at 470. It is obviously lower than our trimming level. I might trim more. I don't know. Like, I'm not going to kind of talk about future moves on the portfolio, but the valuation is just too extended for my liking. Paying at the moment, you're paying 43.35 times sales on a stock that, yes, has a 5-year compound annual growth rate in revenue of 22.55% per year. So I just want you to remember those two numbers. So 43 times sales on about a 22.5 times 5-year compound revenue growth rate. That's a good growth rate, and that's a hell of a price to pay for that growth rate as well. To put that in perspective, in the S&P 500, the next highest price to sales company is MSCI. The guys that do the MSCI World, for example, an analytics company and an index provider and all that, about a $43 billion company. That is at 18 times sales. That is the next most expensive. This is hellishly expensive. So Why is it so expensive, and why does the market believe in it? Well, the guidance was exceptional. So the management came out basically and said, I think the sales guidance for the quarter was going to be just over 7 billion. They came out with like an 11 billion sales guidance for the next quarter. It was just so beyond what the market was expecting. And then they came out and said, we've got the magic sauce. We're gonna be, this is just a gold mine. There's nothing that can stop us. And it was such an aggressive guidance from the company that the market, to an extent, just believed them and said, well, this is amazing. We've got this magic being created in ChatGPT, and you guys are saying that you're going to be the backbone of the future of artificial intelligence. We have to buy you at any price. And that's what the excitement around it. My concern and the risk around this is that guidance was too aggressive. The expectations are incredibly high. If they do not deliver on this, the stock is going to crumble. Now, I'm not saying they can't deliver. It's a great company. I mean, it's over a trillion dollar market cap company now. But there are other risks as well. So yes, there's reasons why it's a niche player, and that other chip makers and semiconductor makers can't compete in the AI space as well as it can. Remember, its business is really broken into the two segments. So the one is kind of focusing on those AI chips. The other is the GPU market. The GPU market, so it's a graphics processing unit. The GPU market, they have plenty of competition from the likes of AMD. Intel as well, for example, just in semiconductors. Tesla could be creating their own chips. There are real competitors here. Is their moat so deep that they will never be able to have a competitor? I don't believe that. I do not believe humans cannot recreate NVIDIA, especially when they see the value that's being created. Viv often talks about it and says that the company that creates AGI will be by far, that's artificial general intelligence, will be by far the most valuable company in the world. Is that company going to be NVIDIA? Probably not. NVIDIA is the architecture. It's in the gold rush, it's selling the picks and shovels. Right now, can other people not sell picks and shovels? Yes, there are real competitors in this market, although the market does believe that their advantage currently is massive. You can't discount the competitors. The guidance might have been too aggressive. As I said, valuation is very high. And then, of course, there's the regulatory barriers as well. So remember, it was about September last year. Everyone seems to have forgotten about this. The government just got involved and said, the US government said you can't sell chips to China. Remember that AI and chips specifically, especially chips with military application, you can easily have regulators stepping in and hampering global trade and shrinking that market size for the business as it just cuts certain products out, like certain products off the market. So just remember that as well. This isn't a no-brainer. Go and buy NVIDIA type stock. And that's why, like I said, we're still at a 4.5% weighting, which I'm actually still a little bit uncomfortable with, to be perfectly honest. But we generally don't just go sell 10% of the portfolio. We'll trim in segments, and who knows when the excitement around NVIDIA is going to end. I mean, this could easily end up at $500, $600, $700 stock, and that might maybe where we trim the next one. But for now, I just wanted to bring it back in line with a more reasonable weighting within the portfolio, because my mandate is also to protect the overall value of our portfolios. And having a 10% weighting in a stock at 43 times sales just seems irresponsible to me. So that's where the rationale for the cut on NVIDIA was. And then final business, and remember, as I said, remember this number, 43 times sales at 22.5 5-year revenue CAGR. Investment case, Alibaba. Okay, Alibaba is trading on 2 times sales. 2 times sales. I'm just going to say that I'll just leave it there, 2 times sales. Except their 5-year revenue CAGR is 27.5%. It has a better 5-year revenue growth rate, and it is 20 times cheaper than NVIDIA, more than 20 times cheaper than NVIDIA. Why is it so cheap? We all know why it's so cheap. It's so cheap because it's a Chinese company, but it's an incredibly good Chinese company. So looking at it, the market that it addresses is incredible. Remember, it is also an AI play as well. So let's start with that. Through their cloud computing, their cloud division is the 4th largest globally by revenue. And it really is a focus for Chinese AI expression. So there is the same kind of AI excitement should be in Alibaba as well. But it's trading, it's 20 times cheaper, and it has a better growth rate. On top of it, their market is massive. And I mean, you remember they operate through 7 different segments. I've got them up on the left-hand side. So they've got everything from digital media and entertainment to, it's more like an Amazon. It's got e-commerce platforms. It's got the cloud computing. It's got all sorts of different things in it. But I mean, it has a 51% market share of online retail sales in China. That is an exciting company. That is an exciting place to be, especially when you're only paying 2 times sales for it. Now, what are the risks? Of course, the risks are regulation. Remember, they disappeared Jack Ma for a while. Jack Ma was not around. He just disappeared. That's the kind of place that you're investing your funds. And that's why I believe this is worth adding to portfolios, but as a diversifying factor. This is not something that you go and bet the farm on. But the Chinese economy works very differently to the US economy. I mean, we are getting Chinese inflation data out tomorrow. The Chinese world is different. It's non-correlated to an extent to the rest of the world. So, and when the Chinese want their stock markets up, they go up dramatically. And I mean, I've got it. I didn't take a longer dated chart for you, but it's not like buying Chinese stocks never delivers returns for shareholders. There are plenty of periods in history, including Alibaba's history, where the gains have been phenomenal. And you can see now we've got a long-term downtrend that's broken out. It's starting to move sideways. And like I said, you do feel that the regulatory environment is improving to an extent, but of course it's always going to be a risk. And then finally, of course, longer-term Chinese demographics are actually against investing in China fully. But again, it depends. Investing in stocks is the price that you pay. So longer term, if we're looking, say, 20, 30 years out, the Chinese demographics don't look great. The Chinese population will be well below 1 billion. And that kind of huge middle class that you're trying to capture is not going to be something that's too exciting. But that's 30 years out. And I mean, I understand stocks are, the discounted future cash flows of all future cash flows. That's the stock price. But it's difficult. It's difficult to look that far out and look at a world where Chinese demographics are playing an issue in the stock price at this stage. But it is a risk. I think you've got to keep that on the table as well. So obviously, global equity portfolio. I've talked a little bit about the mechanics of it, but it's a seg mandate. We open a PSP in your name. We can put them inside life wrappers. We can put them in. We manage for local and offshore trusts. We manage for, as I said, just individuals directly. Minimum investments about is $50,000 into the portfolio because we're doing a seg mandate rather than a unitized CIS, so collective investment scheme. I get to strip off all the CIS costs, but the downside is I can't work with people that want to put in $10,000. It's just not possible. And then obviously, if you want more from us as well, we do a whole lot of newsletters. You can just go on the website, sign up for our newsletters. Christo does some like trading, so we call it Trader Connect. We all kind of chuck ideas around for short-term ideas, mainly for geared derivatives guys that work in our trading accounts. Birthdays is a weekly wrap. I mean, if you haven't watched it, go on YouTube, register, subscribe to our YouTube channel. It's really cool. And then obviously we've got Anthony Clark for selected private clients only, kind of small and mid-cap research. You have to be a client by invitation only. And then Garth McKenzie, who, he's done a training course for us and he's doing some stock picks for us. And we're getting, we're working more and more with him, which I'm always excited about. Well, guys, thanks for the lunchtime market update. Hopefully it was, gave you some idea of how we're thinking and where we're going. It's always a pleasure. We're trying to make it a little bit more condensed, but thanks for participating, and we'll see you out there in the markets.